Curi RMB Capital. Thanks for joining me today as we take a closer look at the cost of holding cash. We'll consider why it may no longer be the right choice for investors as interest rates start to decrease and other assets are likely to offer better returns. As a result of increasing market uncertainty and higher short-term rates from the Federal Reserve's hiking cycle, interest in cash and other short-term investments jumped significantly in recent years. Currently, there are over $6 trillion in assets held in money market funds. That's a record high. But things are changing. Now that the Fed has likely stopped its rate increases and may start reducing rates later this year, holding too much cash may pose an opportunity cost for investors, especially those with long time horizons. Cash has produced an average annual return of about 80 basis points since 2009, and that rate jumped significantly to over 5% in 2023. And yet, despite earning its highest return in over 2 decades last year, cash underperformed nearly all other asset classes. As an investor, you may be tempted to overweight cash to avoid short-term volatility in stocks and bonds. But the Fed has indicated that they will likely begin cutting interest rates by the end of 2024, and this means interest rates on cash investments will likely start falling as the year progresses. This is an important marker for investors to consider investment opportunities in other areas of the market. With the potential for falling interest rates, investors could lock in current higher yields and benefit from the income and diversification of high-quality bonds. Historically, U.S. core bonds have outperformed money markets by a significant margin after the Fed's last hike and subsequent reduction in rates. Looking at the performance of U.S. stocks versus cash since 1926, stocks are the undisputed long-term winner. For example, cash investments underperformed stocks by a whopping 688% over a 20-year holding period. This is a prime example of the opportunity cost of holding cash that we're talking about today. All that being said, having time on your side is a key component to reducing volatility and achieving your investment goals. Time in the market is often more important than timing the market. While markets can be quite volatile over short periods of time, the volatility of returns decreases significantly the longer you remain invested. This is why we believe long-term investors waiting on the sideline in cash would be well served to put that money to work in their diversified portfolio. Let's quickly recap. The Fed's steep rate hike cycle over the last 2 years has increased short-term interest rates, and this, in tandem with market uncertainty, has made cash investments more attractive than they have been since before the financial crisis. But rates have likely peaked, and it would be wise to consider the merits of other investments that may yield more income and growth going forward, such as high-quality bonds and U.S. stocks. Doing so will help you avoid the opportunity costs of being overinvested in cash as interest rates fall. But remember, for long-term investors, the most important thing is getting invested and staying invested. Thanks for joining me today. Reach out to a member of the Curi RMB Capital team if you have any questions about what we discussed. I hope you join us again for our next in-depth perspective on markets and investing.